Hey guys, welcome back to the Investor Series, Winning with Econs channel. Appreciate you guys listening to this. I'm hoping to give another quick 5-minute investment strategy that is very popular in the trading world right now. It's the hidden monopoly strategy. So, monopolies are some of the best investments for lifelong holders. They, on average, can net you 50x to anywhere up to even 200x, depending on the lifetime. And the goal is to not just find a monopoly, but specifically a hidden monopoly, meaning that antitrust laws, big labels will not be going after these companies. They're going to be something that the government regulation will not stop. So hopefully I can explain to you guys what to look for in this channel, not specifically what companies to invest in, but how you guys can spot your own. So before we go into that details, I would like to go over the definition between a true monopoly versus that of a hidden monopoly. What prevents a monopoly from existing is that it would have direct competition, low cost to barriers, meaning that it's going to be easy if you wanted to start your own company to compete with this company. Government prevention of competition, essentially, the government themselves will not go out of their way to stop a state owned enterprise like something you might see in China. So, what we look for is hidden monopolies, companies that have all these variables, but at the same time, they are in their own world of monopoly, and I'll explain to you how that's possible. Um, a lot of these monopolies actually don't even have unique technology that sets them apart. What sets them apart is something like their brand, their incumbent advantage, and that's generally what has protected them for such a long time. So, examples of hidden monopoly, we can start with a very simple one, Clorox. If you're in the United States, you should know this company, but for those of you that aren't, Clorox is a company that produces bleach, Drano, which helps with clogged sinks, and other cleaning and sanitary tools. Now, you might be thinking, what is it that makes this company a monopoly? And essentially, it's the idea that there are competitors. However, despite the economic cycle of anything that happens within your country, you will, in most cases, buy Clorox and have its demand not affected. I'll give you a very simple example. Let's say that the average household has two clogged sinks a year. In that time frame, you will not in any way overuse or underuse the amount of Drano, a Clorox product, regardless of how well you're doing. If you get a raise, you will still use the same amount of Clorox Drano. And if you enter a recession and hypothetically you actually lose your job, you will still use this product as you do not want to use a cheaper product that could potentially cause more damage or require more use than that of a guaranteed high quality product. The company itself may not even be the best, um, highest brand of quality, but they've been around for so long that they're able to sell themselves as this. And another interesting point about this is that Clorox actually increases its price every quarter by about a cent. The reason it does this is to prevent, sorry, not to prevent, but to allow increases in revenue every quarter so that it looks good for earnings and the stock price is able to grow. Another example of this is American Waterworks. So American Waterworks has not been public for as long as a company like Clorox, but essentially their monopoly is as a water utility provider. Again, no matter what happens in the economy, if you lose your job, if you get a promotion, you will still be using the same amount of water within specific areas. What they've been able to benefit in is going into high cost of living areas such as New Jersey and being able to increase prices that has accelerated their price growth within the last decade. Another advantage this company is doing is that they have a monopoly on military bases as the sole provider. Again, not something that another company can't come in and do, but at the same time, they are able to uh, have this unique incumbent advantage which prevents others from competing with them. Now, the trick again, if if monopolies are able to be spotted by these three variables, how can you spot what makes a company hidden versus a true? Because if these are the only variables that can make a company a true monopoly, and that's what we're trying to avoid, how do we spot the hidden monopoly? A simple trick is to look at their financial statements. Specifically, if the company is able to have steady customer base or a growth in customer base despite an increase in price, then that company is a hidden monopoly. Even if they have these three variables, they might still be able to have no one discerning away from what their service offers. So here's an example of one. Google has about a 90% margin on its ad services, and despite increasing its ad pricing, companies are not deterred to going towards Bing and Yahoo. And the reason for this is that even though these are all competitors who offer cheaper prices, we all know the advantages that Google's share has within the search engine optimization space. It's not something that Google has to ever worry about losing. And if you look at the financial statements, Google has an excess amount of cash that it's not even able to give out in dividend because they're running out of ideas of how to invest. This is a company that if you also look at their stock price, you'll notice that they've done well for the last 15 to 20 years because of this lack of competition. Now, on the other hand, here's an example of a company most people think is a hidden monopoly, but in reality it's not. It's Apple. Apple's brand generally allows for it to charge higher prices, and people still buy it with the notion that it presents a higher quality than that of the competition. But as we're learning within the last year or so, that is false. Apple actually recently in its shareholder meetings took out the number of iPhones they have been selling and only putting the overall sales for their iPhones. And the reason they're doing this is because they have found out that if they charge a certain price for their products, they would actually sell less smartphones. And not just that they would lose less, not only will they sell less smartphones, but it's harder for them to reattract customers because companies like Samsung are offering better phones for prices that they know will not be increased significantly. So as a result, people are going with their service a lot less. If you look at the average one of the hidden monopolies prices over the last decade or so, you'll notice that they produce greatly significantly more value than a lot of the competitors. And while this is a strategy that's very hard to do based on the notion of trying to find the financial statements, what makes it a truly great strategy is that monopolies by nature will always continue to exist as new fields start to grow. We are living in an era where technology is starting to expand to different fields like AI and esports, and it's hard to see what that monopoly is, but if you're able to use these financial statements, it is no doubt a lucrative opportunity. As usual, for all my videos, I give no recommendations of specific companies. The companies I've mentioned are just examples. I just wanted to give some kind of financial advice as I do not want to monetize these videos for investments I would make. I would like to offer simple strategies I have picked up in all my experiences in corporate finance. As always, please leave a like or comments on how to improve this video. Thanks for watching.